morning to you and welcome to On the Mark. Along with Mark Pappa, I'm Gary Byron. Mark Pappa is the president, owner, CEO of Financial Resources Group. Now, they're out of Glastonbury, Connecticut, right here in our home state. You can check them out online at FR Plan, F as in Frank, R like financial resources, frplan.com. Better yet, give them a call. There's never any obligation to sit down and meet with Mark. I'm going to tell you, it's life-changing. Even if you've met with other financial advisors, talk to Mark. Other people have left other financial advisors to go with Mark. That's no obligation for that initial consultation. It's eye-opening. 860-657-8380. Let me give it to you again. 860-657-8380. And by the way, if you missed any of those points of contact, no worries. I'll give it all to you at least a couple more times before the show is over. Good morning, Mark. Great to see you.
Hey, good morning, Gary. How are you?
I am. I'm not doing too shabby. Listen, I'll be honest with you. I'm getting ready for the Christmas season. We're less than a week away. Are you in the festive spirit right now?
Yeah, absolutely. Good. Who doesn't like Christmas, right?
Exactly. It's not just for kids.
Yeah, I'm looking forward to winding down a bit, too, and, just sort of relaxing.
Good. You need to.
Yeah, I would say so. It's never a bad thing to take advantage of the holidays.
You were telling me, I think, was it last week or the week before, that week of shutdown for a lot of industry, the week between Christmas and New Year's, that you're working. You're not shutting it down.
We'll be working. I'm saying I'm probably not going to be, going head over heels. But there are always people who might work or whatever. And again, I am changing my business model to people who are only retired. Now that doesn't include existing clients, obviously, but new clients, anyone coming on new. I want people who are fully retired or about to retire within a couple months.
I was going to say, what if someone's 60, they're a millionaire or close to it?
Yeah, let's sit down and see if you can retire. That's something I would love to do.
There are people who can, though, but they love their job so much.
Right. Well, here's the other problem. If you're still working and you love your job, but you haven't saved enough, that's a problem because, I met a lot of people who were still in their late 60s. They hadn't saved enough, but then they're so afraid to make a decision because that's all they have.
Yeah.
But maybe they should have had an advisor like me that could have retired at 62 or 63.
There you go.
And I see a lot of those people sitting in cash, scared of the market, but they don't want advice. And those are the people I will do my best to help. But frankly, I also don't bang my head against the wall with those. So what I'm looking to do is I want to work with people who are higher net worth people. You look at some of my competition, they have a threshold of $1 million in investable assets. So that's where I want to put my benchmark. If, look at all the work we're doing for people. I know. And if you have less than that, but you're somebody who really needs help, of course I'm not going to turn you away. But at the same time, I'm also, not going to cast a wide net in work all those extra hours for people. And I noticed that it's a very difficult thing to market, especially with the seminars. And we did very well with the seminars.
I hope you start those back up after the
I will be doing that. That's coming up in Ruth Chris. But I'm going to tighten up my criteria, Gary. Again, I'm targeting bigger households, less people, and even a smaller room. So it's going to be a much more exclusive crowd than the last one. Okay. And again, I had some really awesome people come through, and then I had other people who never even opened up the booklet. So
no, they just had their free steak.
They had their steak. That's fine. Hope they enjoyed it. But I'm looking for people who are a little bit more serious and people who actually can use my advice, who need my help. Not the people who think, oh yeah, I've got my money in an index fund, I'm beating the market, or I'm beating the advisor, and you want to pound your chest? God bless you. We'll talk when the market's down 40%. We'll see how you feel then.
Earlier, this was a few weeks ago, maybe it was just before Thanksgiving, you talked about true diversification and managing risk in volatile times. And I just read a recent Barron's article that's very much on that point, actually, about how AI could supercharge the economy, but in rising deficits might fight it to a draw, and how investors need to be ready for some potential downturn after years of strong gains. So The piece kind of lays out some practical year-end moves to protect retirement portfolios. And I wanted to this morning maybe spend a little time on that. What are your thoughts on, the key themes in that? I don't know. Did you see that article? I would imagine you probably saw it as well.
Congratulations to you for reading Barron's, Gary. 'Cause that's what I do on my Sundays.
Well, I was doing it in preparation for the show, a little bit, so I took a glance at it.
Congratulations
and that article
to you.
stuck out at me.
Yeah, that's like for me, it's always been the weekend. On the weekend, that's pretty much the Bible for the weekend to read. You have to read Barron's. If you're going to be in this business, you better, sharp people. I mean, they have Barron's. They have Barron's Penta, which is for people over 10 million. Wealthy people read this stuff.
I didn't look at that one.
People in the know read Barron's. I'm not saying that you shouldn't read other publications. There's so many other places you can look, but that's one of the places I better make sure I read that. I better make sure I read my Wall Street Journal, my Investment Business.
Well, I get the Wall Street Journal. I subscribe to it.
I was trained, Gary, that reading and learning and knowing new things, you have to be constantly on top of your game. Again, there's some of my competition that are great schmoozers, great salespeople that were trained to sell products. I don't know if they might know a few things about the market, but I am a student of the market, and I think it's important to not only read Barron's, but read all the books, the famous books that are out there. There's so many good ones out there. Some of them I could,
especially in winter. Make a cup of coffee, put a fire in a fireplace.
You know what?
I could read for hours.
Let's do a show to summarize some of the books that I've read, and so I could share that some of the knowledge of those books with some of the people.
Let's do that next week because that's a great year-end topic.
Yeah, it is. And there's Andrew Ross Sorkin just came out with a new book on the crash of 29 a couple months ago, which is very popular. But But anyway, so thank you for reading Barron's, Gary, because it's a big deal.
Well, I do it for the prep for the show. So.
Yeah, and I want to talk about some of the things that they said in that article. First off, rising deficits are a bad thing and always have been. What that means is the government is spending too much money and it crowds out the private sector. You also have rising debt. Rising debt means a greater percentage of our federal budget needs to go to pay interest on the debt, which is above $1 trillion a year. You couple that with some of the other issues in terms of trying to bring that debt down. There's absolutely very little. I mean, look what they did to Doge. They attacked it. Yeah. They attacked it. They said it's been a failure. I think Doge just went internal and stopped being public. And
he ended it prematurely. He said he was going to do it for a year and a half, and then he did it for about 5 months.
5 months. So I don't really know what's going on with that. But here's the bottom line. Eventually it's going to come to roost. And the bill's going to be due, and it's going to not be a very pretty thing. We're also seeing debasement, meaning in debasement in simple terms means we're going to try and inflate our way out of the debt problem. And, but that can't be good for the long-term prospect. It slows down the economy, Gary, period. It's look at Japan. Japan has massive, massive debt, but yet massive, massive debts, and they've had a hard time reinflating their economy. So what are they doing? They're actually raising interest rates in Japan. So that's actually some of the reasons we saw about a month ago, a little more, a lot of volatility because the Japanese carry trade where you can borrow it next to zero in Japan and invest in the United States, and that arbitrage started become unwound. And then probably one of the reasons you saw Bitcoin and some of the cryptos take such a big hit as a result of that. Because
2 weeks ago?
A lot of people were borrowing. So being diversified and truly diversified is obviously one of the most important things to do. And what does that mean? So we can get into what that means in a minute.
Well, I mean, there are several concrete steps, right? I mean, I was looking at the S&P 500 trading at high valuations and concentrated in just a handful of mega cap tech AI stocks. The risk of a sharp correction, I think, is real, especially if we hit a recession. One that jumped out at me was consolidating accounts. Why do you think that's so important?
Well, so consolidating accounts is extremely important. Let me just let me talk about that. Then I want to talk about what we're going to be doing to diversify. So, because it's definitely different than just what you look at a pie chart and on some website. We're very I wouldn't want to say we're very strategic in our approach. We just changed our model portfolio for 20. It's going to be for the Q1 of 26, excuse me. We're well positioned for that. So I'm going to talk about some of that. So All right. Wait, Gary, your question again was? My apology.
Oh, no, I just, there were a lot of, they suggest this article.
Yes.
With the S&P. They suggest
consolidation is huge.
Right.
Okay. Here's the problem. Okay, you have I'll meet people. Okay, I have my account at Vanguard. My wife's got her stuff at TD Ameritrade, at Schwab. And, I have a guy at the XYZ broker-dealer. And then, we have some 529 accounts for the kids. And I'm like, okay. And then I'm looking at, okay, this one has one kind of portfolio. That one has one kind. This one has a whole bunch of stocks. The portfolio makes absolutely zero sense, right? You want your portfolio to look like a pension fund. So I sat on the pension committee. I was on pension committee for the town of Newington when I was there. And the manager there was actually one of the top advisors in the country. He was a top 100 Barron's advisor from UBS.
Really?
I really like that guy, yes.
I had no idea.
Mark Shagoski. I'll even say his name. He's my competition. But, I mean, he manages like $6-7 billion. And I don't even know if he's still there. But here's the bottom line. Probably he really knew his stuff. He knew his stuff. He was a reader. I got along with him very, very well. But he knew what a diversified portfolio needed to look like. You needed to have large cap U.S. You had to have large cap, you have to have mid caps, medium companies. You have to have a little bit of small companies. You have to have some real estate. You have to have some hard assets like commodities. You had to have a good mix in your portfolio. You can't have anything that's outsized, taking an outside risk, especially in a pension fund. Now, why would I say would a retiree want their account to look like a pension fund? Because it should, because guess what? You're living on that money. And your money should look just like the pension fund your mom and dad had when they had their pension. And, as long as the pension didn't go bust or the company didn't underfund or the company didn't go bankrupt, you were fine, right? But it should be properly managed. It should look like a pension fund. It shouldn't look like, okay, I'm killing the market and I've got, 5 stocks, carrying, 80% of my returns or 50% of my returns. And that's what a lot of people have right now. If it's not that, it's the opposite. They're holding on to way too much cash, which is called the cash drag, because they're scared of the market. So they put their money in a bond fund and not knowing what's going on. They have no clue what's going on in the bond fund. You have 1 to 3 year bonds. You have 5 to 10, 10 to 20, 20 to 30s. Those 30-year bonds, when rates spiked up, lost almost 30%. Corporate bonds during that same period of time at 22 lost 25%. The actual aggregate, the Barclays Ag, which is now I think the Bloomberg Ag, lost 12.5% of their safe money. You can't just do the pie chart, the 60-40, and like these magazines tell you to do. They're not telling you what's actually potentially going to happen. Now we're in a downward cycle for interest rates, but are we in the market? Do we really have time when we want to just live on our money comfortably to try and bet on directionals? And figure out, okay, if I buy the 30-year Treasury, I'm going to get rich, or is that for a hedge fund? Right? Let the hedge funds. That's what the hedge funds do.
That's what they're there for.
They're going to bet on a 30-year Treasury. They're going to buy it thinking that rates come down, hopefully the yields drop, and they're going to make a bundle of money. Buy the options, buy the derivatives, whatever. We're here to just manage people's risk. So diversification is huge. And one of the main things I would say is, when a good friend of mine in New York at Astoria Advisors, his name is John Davi. I quote him often. You'll see him on CNBC from now and then. But, we're out of that deflationary cycle now. We're in an inflationary cycle. It's going to be higher for longer. Once the genie comes out of the bottle, inflation is going to be a little bit stickier than normal. So in a note that he gave me, he says we're in a K-shaped economy, so GDP prints at 3% and everybody cheers, but most of the country is still living paycheck to paycheck, Gary. We saw that in the last election. Okay, people are not feeling, prosperous.
Well, it hasn't been a year that Trump has been in office and the big, beautiful bill starts to...
It hasn't happened, right.
No.
Once
but
that
it will
kicks in
the first
those
quarter
big
of next year.
Tax returns, the $6,000 deduction for the OBBB, all those things all those incentives starts kicking in. I think the next year, I'm very bullish on the market next year and thereafter. But yeah, they're being squeezed by higher inflation. Wages aren't really going up. The jobs market is a little bit soft here, Gary. Let's face it. AI is starting to eat away at some of these mundane jobs or some of these other jobs that are out there. People are becoming more and more efficient. But again, the bottom line is we want to also not just have all our money in the Magnificent Seven AI trade, which has basically carried the market since 2022. We want to be in financials. We want to be in energy, because energy is a big part of that whole trade. And all sorts of energy, global energy, not just local energy, not just nuclear, not just uranium. We want to be in a global energy. So we have a global energy fund. I won't name just yet that we actually allocated into. You want to own materials, right? You want to own materials. So we've seen a big push into materials for the rare earths, right? You've seen that. So you have to have a little bit there. You need to be far more diversified. You have to have money overseas as well. Some of the bigger companies, the European companies, they're consumer-based, but, they like to pay nice dividends. They tend to be a little bit less growthy. They're more value-oriented. And there was a great amount of value at the beginning of the year where everybody decided they were going to move money out of the U.S., not sure what's going to happen with tariffs, not sure what was going to happen with trade. And, you saw that April tariff tantrum again, and then the taco trade where Trump changed his mind. But, long story short, you have to make sure that you have your money, your bets spread around. And then having money in Asia. I don't know, at night, you can watch Bloomberg Asia. I was listening the other day. There was a gentleman on, I can't remember what company it wasn't quoting, but they're doing a ton of business in Japan right now. There's a ton of value. Private equity firms are investing in Japanese companies. So there's some people that really like the outlook of Japan. So you have to have that, a good mix of your portfolio. It can't just be about, okay, we're going to bet everything on, 7 companies. Because that's what, if you're an S&P 500 index fund, that's what you're doing.
You've been stressing diversification really since we started this show. Folks, you are listening to On the Mark alongside Mark Pappa. I'm Gary Byron. Mark is the owner of Financial Resources Group over there in Glastonbury. You can find him online at frplan.com. And his phone number, this is so significant, 860-657-8380. And, of course, I'll repeat those again more towards the end of the show. By the way, they also talked about rebalancing back into bonds using RMDs kind of as a balancing or maybe even a rebalancing tool and some tax smart moves. Do you have any quick tips here? Or?
Yeah, that's another thing, Gary. So, one other thing I want to bring up is, okay, I talked about people having their accounts all over the place with 2 different advisors and blah, blah, blah. That makes no sense because now you don't have that pension fund.
Right,
and now you have one advisor with this strategy and you probably filled out that risk questionnaire 10 years ago doing one thing, and then you have another advisor doing another thing. And they're most likely they're just butting heads working against each other. And then what I also find, though, a lot of times the people who do have consolidated accounts, that they have 10 or 15 different funds in that account, sometimes 20 different funds, and we'll find that all the funds are doing the same thing. I'm like, it's preposterous. So one of the big firms, again, I won't mention names, there was a situation where they had 28 different positions, and they had them in like 12 to 15 mutual funds, okay? And then what they did is they bought exchange-traded funds in that same portfolio. And I'm saying to myself, I looked at all the different stock holdings. Why would you pay for the mutual funds, right, which is average? Let's call the average expense ratio was like 40 basis points or 4/10 of 1%. That's low, basically. It's probably higher. When the index funds were only 0.004%, 10 times more expensive, Gary. So why wouldn't the advisor just buy the index funds and not the mutual funds?
Of course, right.
And as I mentioned in the last show, there's incentives, I'm sure, for some of these advisors to do that. Or a lot of times the ETF, exchange traded fund, won't have a 5-year track record. So what they do is the company will launch their own exchange traded fund and they pop it into your portfolio with very little track record. They'll pop it into your portfolio so that they could seed it so then they can then sell it out to other people. So we see that a lot too.
Are bonds back?
I would say with yields are great right now. Obviously, they've been great for a while. But I don't think bonds are back. I think if you own bonds in 2022 and you bought bonds when their average yield was 2%, you're still underwater on some of your bonds unless you bought short-term bonds. And your long-term bonds are still underwater most likely until rates go back to zero, which isn't happening. But yeah, bonds are back. I could say that it's, rates are going down. So when rates go down, we do this exercise with folks. Bond values go up.
10-year treasuries are like around 4% right now, right?
Yeah, right around 4.
Yeah, okay.
And the whole other argument has been, a lot of people feel that because of all the debt we have, and because of the spending and the lack of discipline, even though we cut interest rates, we're going to, like a bond, a junk bond, you're going to have to offer more interest to the customer in order to buy your bond. So they're kind of afraid that this, the Fed's interest rate cycle, if it gets too aggressive, we're going to have inflation. And then at the same time, if it's not aggressive enough, our job market gets hurt. However, if you're not offering me greater yield because your risk is higher of default, then I'm not buying. So that could spike yields too. Yields may not go down as quickly as people anticipated.
What if you're 73 age or older?
Well, if you're 73 or older, I don't know. I think the 73 or older part of the article, which talked about your required minimum distributions. So you shouldn't be waiting till 73, by the way. So let's talk about a little bit about income planning, Gary. You should not be waiting to 73 to take your RMD, or you shouldn't be waiting to 75 to take your RMD if you were born after 1960. Okay. You should be taking withdrawals from that 401k, doing Roth conversions so we can do a Roth blueprint for you. The Roth blueprint, Gary, we've seen $5 million accounts do Roth conversions. And even if you go to the 32 bracket, tax bracket, it still works, and it works very well. There's no reason why anybody's advisor should be waiting to 73 and kicking the can down the road, because all you're doing is creating a bigger problem. You're going to have bigger required minimum distributions that are forced upon you. You're going to have to, most likely, depending on your income sources, Social Security, maybe a little bit of a pension, you have a big required minimum distribution. Now you just increase your IRMA or your Medicare costs. Now you also just put yourself in higher tax brackets throughout the rest of your retirement. You also have what's called the widow's penalty, where if when one of you passes, your wife's going to inherit a very large, or the husband, a very large IRA, and they have to file as a single person unless they get married again, which is never really a good idea at that age, without some very deep financial planning to protect your children. So, you have to be so careful. So there's a lot to it, Gary.
There's
more
also
than just that.
There's a static 4% rule for retirees.
Oh,
right?
My favorite 4% rule. Yes, this is the biggest fraud on Wall Street, and I'm going to say it. It is the biggest fraud ever. And again, I sound like Trump, but it is one of the biggest frauds ever.
The biggest.
It really is a fraud, because really what it's done, it's robbed so many people that follow that rule of additional income. It's robbed them of lifestyle. It's robbed them from paying lower fees over time. The whole rule, and I don't care what anyone says, I think everybody loves it, is because, that means if I'm a big brokerage firm or a financial planning firm, I could project that I'm only going to lose 4% of my asset base every year, and all I need to do is grow at 6% net 2 after fees, and I'm good, and I can still grow my business. But I totally dislike it, and in fact, there's been so many new studies. So Morningstar did a study a while back, and they were saying somewhere in the neighborhood of, because interest rates, 2022, they actually, I had this linked on my website, Gary. So in 2022, Morningstar lowered the estimate of the 4% rule to 3.8%. They said due to higher inflation, low bond yields, and elevated valuations. So in 2023 and 24, they changed it to 3.8 and 3.9. And in 2025, they bumped it up to 3.9% for balanced portfolios. Then that represents a modest increase from 2022. Inflation's moderate. They give you all these excuses, all these reasons. I think that's just for anybody. If you want it, you want that vanilla retirement, you want to be in stocks and bonds and go do this on your own and read Morningstar and go read Kiplinger's. Good. You deserve this advice. You deserve to be robbed by the 4% rule. Or you can come to me. And Gary, we're looking at 5.5. And I mean, even without people changing their investments or moving their money, there's even a strategy that will, for people that are in a little bit more of a pickle, but using another strategy, we've seen as high as 6% withdrawals. Now, again, these are to cover a 30-year retirement. So then, a lot of other folks will look at us and say, you know what, as long as your returns are there, you should be comfortably able to withdraw 4 to 5%. Easily. I would say 5% is a minimum if you do it correctly. And that means you have to be smart about how you diversify your portfolio. You have to be smart about how you protect some of your money. And you have to not listen to conventional wisdom and, Googling on the internet and reading all these bad articles and stuff, and actually just sit down and figure out what's going to be best for you. So that's what I do. I sit down and say, what's going to be best for you? How much income do you need? And we will get you close to that number as possible. We'll get you there. And then sometimes, cutting back your budget isn't, for some people.
But you got to
they have
factor
do
Social
that.
Security into that as well.
You do. There's Social Security, there's pension, there's all sorts of different things. But then again, Roth conversions, Gary. Roth conversions are the key for the future. You have another 8 years of that's it. After that, I think taxes are going to go way up. You have an 8-year window to get your conversions done, and that's where we can illustrate that on our Roth Blueprint software, for sure.
They can't extend that 8 years?
You can. It's just your tax rates are going to go up, and it's going to be more expensive to convert. That's what we think, at least. I mean, look, we have $39 trillion in debt. Something's going to have to break. Taxes are going to go up, and not just on a few, on everybody.
What about the interest rate? I only got about a minute left. You think it's going to go down?
Yeah, I think it has to come down in order to keep the economy cranking. I think the jobs market, again, we've seen weakness in the jobs market. I think a lot of that is a lag, and a lot of that has to do with the uncertainty of what was going to happen with tariffs and trade, and will the tariffs cause inflation? It's hard to say. When you look at the political version of that, everyone's like, oh, everything's so expensive still. And again, you can't just get rid of inflation overnight unless you want to crash the economy. Then what do you have to do? You have to cut rates.
Well, Trump takes a lot of heat for the inflation still being high. Are you thinking in May when is a new Fed director?
Yeah, I mean, he did say that he wasn't going to be.
How much of a cut do you foresee?
I would say another 50 to 75 basis points is going to be necessary to keep the jobs market going. We had a very tight labor market prior to that, but things are changing. All right. But Gary, one other thing I want to bring up.
You got to be quick.
Good news is I read an article that the Hartford, Connecticut is one of the top real estate markets in the country. Because the cities are so expensive, speaking about affordability, Boston and New York, they're moving to middle tier metro areas.
FR Plan, Financial Resources Group. frplan.com is the website you need to head to. Let's have you schedule a no-obligation consultation with this guy, Mark Pappa, right here. His offices are in Glastonbury, Connecticut. Call him today, now, 860-657-8380. Even if you can't meet with him till after Christmas or after the New Year, get on the schedule, 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.